think things look pretty good right now. I think we've just seen that markets are extremely emotional at the moment, and that a little bit of news, good or bad, can really sway things quite a bit. 10 years into this cycle, whole lot of anxiety about when things are going bad, when things are going wrong. And I think that the data coming in right now are just mixed at best. I think there is some concern for slowdown in the short term, but for me, no real risk of a recession.
What does that mean for the market multiple? So we're now actually only off, what, 3.5% from record highs? How do you look at what's a fair value right now?
Well, I think there's room for multiple expansion right now. I think earnings growth actually is looking okay. 2019 is not going to be 2018. We're not getting double digits, but we've started to see some positive momentum even in the second quarter season. I think if the Fed keeps rates low, and it looks like they're probably going to cut even further, that just allows for more multiple expansion in the market as well. I think equities grind higher.
I mean, a lot of companies did meet or beat expectations, but a lot of them were lowered.
And the expectations were very low, absolutely. Yeah, I mean, I think there was a huge, quite a bit of pessimism baked into the season, especially because the comps were so hard, especially because we thought the economy was going to slow down faster than it has. Things are looking better than anticipated.
John, talk about a hot market. Municipals. I mean, I don't know why every municipality in the country isn't taking this opportunity to issue if they need to raise debt. Is it still a good time to potentially be a buyer?
Yeah, municipals have earned back a little bit of the softness that they experienced in 2018 when the Fed increased short-term interest rates 4 times. So in terms of the overall interest rate environment plus the municipal ratios relative to taxable fixed income, relative to treasuries, have kind of earned that back. But just in terms of current tax-exempt cash flow, there's tremendous demand for current tax-exempt cash flow. And still pretty reasonable valuations on a relative basis. So supply's been a little bit disappointing. So I would anticipate we might get a little bit of a bump up in new issue supply, as you suggest, in terms of municipalities issuing more debt, because definitely the demand is there.
Well, the appetite has increased as a result, particularly in those high tax states, of no longer being able to deduct your state and local income taxes, right?
That's definitely part of it. I think some of the tax advantages maybe have been overlooked. Even though the top bracket was cut from 39.6 to 37, munis are the only asset class that is exempt from the 3.8% Medicare tax. People forget about that. Plus, the state income taxes are as high as 13.3% in California. And it's sort of the only game in town in terms of mitigating your effective tax rate. So if you don't have as much interest rate concerns, muni investors aren't necessarily betting that rates drop, but they just don't like to see rates rise sharply to create a NAV deterioration. If rates are largely stable, if they're going to stay in this current trading range, then the tax benefits and the credit quality combined are actually fairly good for demand in this marketplace.
So, Mark, what are you telling clients and people about stocks versus bonds right now? How much exposure of each?
I mean, low rates are, I think, here to stay for the foreseeable future, probably through the decade. I think you're going to have, like I said earlier, you got a dividend yield for some of these stocks that's way higher than any of the yields that you're getting on any paper for the government or any corporate paper.
But we're kind of in this funk right now where the low yields are actually scary or a negative
I think
stocks.
For some it is scary. You're also seeing it flow through to the consumer a little bit, and I think since the rates dropped over the last 6 to 8 weeks, I haven't seen a lot of news that the consumer's dead here. And I think the wage inflation has helped a little bit as well. And I think I'd be much more worrisome if the consumer felt really tapped out. And I'm just not getting that sense right now from what I see from some of the companies. The haves are doing well. You look at Target and others doing extremely well, telling me that the consumer's doing okay.
John Miller, what are your latest expectations for the Fed, and what is the bond market telling you right now? Higher yields, but another inversion.
Yeah, it's pretty amazing environment in that I think U.S. yields are really being dragged down by the global environment. But when we look at unemployment claims today, or we look at retail sales outperforming expectations last week, the unemployment rate still at 3.7%. We're not really seeing a deterioration in municipal credit, or the revenue streams that the states are collecting are still fairly good. So the U.S. economy remains very stable, and that's been good for credit qualities. But now, having said that, with Germany probably tipping into a mild recession, perhaps, and their manufacturing sector is weak, obviously the headwinds of the trade war That's creating this global environment where the ECB is going to embark on more bond buying. And so it's the negative rates in Europe and Japan that are actually pulling down Treasury rates. I mean, the 2-year to 10-year is virtually flat. They're virtually even in yield. So I don't think that's a really potent recessionary signal right now. So I think that the U.S. is still growing, but those rates are being dragged down by overseas bond purchase programs.